Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at HOOD, or Robinhood Financial or Robinhood Markets, Inc. Robinhood Financial LLC is a registered broker-dealer. Robinhood Securities LLC provides brokerage clearing services, and Robinhood Crypto provides cryptocurrency trading. Here's the barchart.com technical opinion rating for Hood. The rating is a 100% buy and ranks in the top 1% of all short-term signal directions. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that Hood is well above the moving average line, so the monthly trend in Hood is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in Hood is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. Hood is 9 cents below the upper Keltner channel line, so Hood is inside the buy zone. Since the trend is up, we want to buy a call. Hood has plenty of option chains to choose from. We're going to use the Jan 17 chain. Right now, the January 17 options have 33 days to expiration. Here's the Hood option chain for Jan 17. Hood closed at 40.20 on Friday. That means any calls on the list from 30 to 40 are in the money. Let's take a look at the profit potential for purchasing the 40 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 40 call is 325 to 335. We try to enter at the midpoint, so we'll use 330 as the buy price. Our call option calculator shows the profit potential for this call based on Hood price changes at option expiration from flat to a 12.5% increase in price. We can see that if the Hood stock price is flat at 40.20 at option expiration, the 40 call will lose 93.9% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule is to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at the 34 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 34 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the Hood stock price is up 1%, the 34 call will lose 5.7% of its value. We want that to be break even or better, so the 34 call does not meet our requirements. Let's see if the 28 call will work. The bid-ask spread for the 28 call is 12.05 to 12.90. We try to enter at the midpoint, so we'll use 12.50 as the buy price. The 28 call works. If the Hood stock price is up 1%, the 28 call will make a 0.8% or $10 profit. That's better than break even, so the 28 call is the one we'll buy. The call option purchase calculator also shows that if the Hood stock price increases by 2.5%, the 28 call will make a 5.6% or $71 profit. If the Hood stock price increases by 5%, the 28 call will make a 13.7% or $171 profit. If the Hood stock price increases by 7.5%, the 28 call will make a 21.7% or $272 profit. The plus 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the Hood stock price does not make the expected move up and it remains flat at expiration, The 28 call would only lose minus 2.4% or minus $30 compared to the, let's see, where is it? Compared to the minus 93.9% or minus $310 for the 40 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the hood Jan 1730 strike call and sell to open the Jan 1740 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 30 call for $10.55 and sell the 40 call for $3.30. $10.55 minus $3.30 equals $7.25. So the entry price or debit cost for the spread is $725. The call option spread analysis calculator picture shows that the spread will make a 37.9% or $275 profit if the hood stop price remains flat or increases in price when the options expire. The profits slide down from there. If hood is down 7.5% at expiration, the trade will lose 0.9% or $6. Creating the debit spread will allow us to collect a $330 cash credit to our brokerage account for the sale of the 40 call. As we said on the previous slide, this reduces the cost of entering the spread to $725. Here's a note regarding earnings reports. The next hood earnings report is scheduled for Jan 29. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the hood 28 strike call for $12.50. We also reviewed the spread. The spread said to buy to open the hood Jan 1730 strike call. Whoops, I didn't say it was a Jan 17 for the 28 call. It is. Buy to open the hood Jan 1730 strike call and sell to open the hood Jan 1740 strike call at a debit of $725. Thank you for joining us. We look forward to seeing you again next week.